Good morning from London. I'm Kriti Gupta alongside Valerie Tytel and Tom Mackenzie. We're an hour away from the opening trade. Here's what you need to know. Less than 48 hours to a U.S. government shutdown as top congressional leaders look to meet President Trump at the White House today, all in the hopes of securing a short-term funding bill. We're also live at the UK Labour Party conference where Nigel Farage's reform looms large, and Prime Minister Starmer says his government is in a battle for the nation's soul. And over in Spain, they're winning a double upgrade from Moody's and Fitch, citing a strong economy, even as worries around the public debt linger. Val.
Starting this Monday on a positive note, S&P Futures in the green on the confirmation that Trump is going to meet Democratic lawmakers at the White House today. More on that in just a moment. Euro Stoxx 50 Futures also in the green. We have the dollar softer, but it is coming off the best week in 2 months for the Bloomberg Dollar Spot Index. And those 10-year yields headed 2 basis points lower. 415 is where we trade. The countdown to the opening trade starts right now.
Good Monday morning. Lots to digest today, or is there nothing? We're talking about how boring today's news agenda is, but perhaps that's because it is a countdown to the real action, which is tomorrow. The U.S. shutdown, U.S. government shutdown, a potential U.S. government shutdown is where we're headed. We're in the last final hours. Do we get a Hail Mary, or do we just let the government shut down?
Yeah, less than 48 hours to go. Tuesday night at midnight is the deadline for the U.S. shutdown. Whether we'll see an agreement between Democratic and Republican lawmakers is still up in the air. But there is some positive news that we are going to have a big meeting at the White House later today at 3 p.m. Eastern time. That's 8 p.m. London, so well after the close here. But the White House, Trump has invited both Democrats and Republicans to sit down with him later today. As usual, healthcare spending is something that's going to be hotly debated. Democrats want an extension of some healthcare credits. The White House, on the other side, is threatening mass layoffs for government jobs in Washington, D.C. if they don't come to some sort of agreement. Republican lawmakers say those healthcare credits extensions can wait. They want to see new income limits when it comes to those credit extensions.
So earlier this year, Chuck Schumer took a lot of heat from the Democrats for passing the bill because they were concerned. The rationale was they were concerned that this would just accelerate the Doge cuts that were taking place across the federal government. And he got a lot of pushback, even from Hakeem Jeffries. So it's always about the political cost in terms of how this potential shutdown lands, isn't it? And this is only a stopgap measure as well. But is this the Democratic Party that's taking a harder line? And are we getting closer, actually, to a moment where it breaks?
Well, the healthcare subsidies is the key piece, as you were pointing out, because there are two potential bills on the table. One is coming out that would extend until about November 20th, so right in time for Thanksgiving and the U.S. holidays. And the other is in December. So we're going to have this conversation again in 2/3 months. It's very exciting stuff. But one of the key concerns to your point about the political cost is that the healthcare subsidies impact both Democrats and Republicans. So there is a concern in Washington is, does this ultimately influence something that happens in the midterms in 2026 and see the pendulum shift there? There's also a narrative that does the White House, for example, actually want the government to shut down because, to your point, it would save costs. It's a very dark way of thinking, but there is a narrative there that suggests that actually, at the end of the day, a government shutdown is ultimately a cost-saving measure. So we'll see how that shows up. The bond market's not blinking much.
Well, let's talk about the market concerns in this, and that is that we don't get this Friday non-farm payroll report ahead of the Fed's meeting in October. If they go into that without any new news on the labor market, it's really hard for them to be incrementally more dovish without this payroll report. So that's the key risk for the market, is that perhaps the bond market rally of late just continues to stall further if we don't get the data released on Friday, and we have to rely on the ADP private payroll metric that comes out on Wednesday instead.
OK, so non-farm payrolls, we'll see if that actually comes through for the markets as those bonds, as you say, have been bid. They're bid in the session today, but you need that additional detail as markets start to question whether and how far the Fed can go. October is priced at about 85% the last time I checked. So from the midterm view, at least that seems to be where the Democrats and Republicans are certainly looking in terms of their electoral prospects, the midterm elections and how that all calculates in. The UK Labour government is already looking at the next election, and you get that sense, don't you, with the Prime Minister under pressure and the rise of Reform UK. Our UK correspondent Lizzie Burden is at the Labour Party's conference in Liverpool, the UK's governing party, of course. Lizzie, what is the mood on the ground?
Well, it's make or break for Keir Starmer really here, Tom. so much pressure on Keir Starmer because, as you say, the polls show that if there were an election right now, he would lose to Nigel Farage's Reform UK party. And so many of his MPs just got their first taste of Parliament 15 months ago, so they do not want to be ousted, hence why this speculation is rife here in the corridors of this conference hall about who could potentially replace Starmer. You've had packed out rooms for Andy Burnham, the Mayor of Manchester, who's openly criticising Keir Starmer, talking about how there's a culture of fear in this party, how this government is in hock to the bond market, which brings me to the Chancellor's speech. We're waiting for that at 12 p.m. London time. Absolutely crucial for Rachel Reeves. We know that the fiscal backdrop is pretty precarious, in her words. You've got gilt yields at multi-year highs, recent gilt auctions seeing pretty weak demand, and so there's a lot of speculation, and there has been all the way since the spring statement about which taxes she is going to raise. And yet there is also speculation that in this speech today she's going to drop hints about lifting the two-child benefit cap. How is she going to pay for that? We heard from the Prime Minister Keir Starmer speaking to the BBC yesterday, repeatedly refusing to give a yes-no answer about whether he could guarantee they won't raise VAT, one of the three main tax levers that, of course, in the Labour manifesto they said they wouldn't raise. If there is a hint today of unfunded spending, you'll surely see it weighing on gilts and sterling today.
OK, Lizzie Burden in Liverpool. We'll have plenty more, of course, with Lizzie throughout the next couple of hours. And Lizzie, of course, bringing us that interview with the Chancellor at around 9:15 UK time that you need to stay tuned for. It's quite something, isn't it, when you have someone who is bidding to take the position from the Prime Minister, of course, the Mayor of Manchester, Andy Burnham, someone who is deeply popular and has deep experience, talking about being overly in hock to the bond market. That tells us either politically he's throwing red meat to the left, or he is demonstrative of elements of a Labour Party that fundamentally misunderstand the fiscal constraints that this UK government and UK economy face.
Yeah, perhaps he's just not a fan of these fiscal rules that is preventing the Labour Party from being a traditional Labour Party and helping those, blue-collar workers. But I see a lot of similarities to what's going on, to what happened to Trump, right? You had the Democrats calling him racist, but in doing that, they really alienated some of those voters who were on the fence about to vote for Trump, in this case, about to vote for Nigel Farage or switch their allegiance. So it seems like there are a lot of similarities to what's going on in the UK, which what happened in the US.
Yeah, it's a fascinating one, though, if we're making that comparison to start talking about, yes, of course, the politics is one piece of it, but the market implications and the fiscal side of it as well, because you're seeing the same fiscal issues on both sides of the Atlantic and two very different approaches in terms of how to actually fundraise. In the UK, talking about these tax hikes, yes, loosening business conditions, but ultimately as a fundraising measure, getting some of that money up. On the other hand, the US, you're talking about things like tax cuts and efficiency cuts, Doge cuts as well. And I think that really speaks to this idea that there are two different methods that are being used here on both sides of the Atlantic to address the very same policy concerns.
Yeah, or is there a third way, which is the Spanish way, where you have political instability but a seemingly booming economy, Kriti? Is there a link between Kriti's visits to Spain and an economy that's growing at more than 2.5% a year?
I would love to take credit for the growth of the Spanish economy. I'm waiting for my trophy. It should arrive any day now. But I think this is really important here, that Spain's economy has been in a growth trajectory for really over 10 years, going back to the GFC as well. So some of this is an immigration story because they are taking in a lot of not only people from Latin America that are now coming, and that wealth transfer is happening from what used to be Latin America to Miami down to Madrid. So that is one piece of it. They're also attracting talent from other parts of Europe and arguably from the Middle East as well. So that immigration story that has been such a thorn in UK and American policy is actually a big plus for Spain here. That being said, I think what's crucial is that they're also still dealing with the same fiscal debt issues. Their public debt outstanding is still an issue, the same as everyone else. What they're doing differently, though, is their businesses are growing faster, and they have this Latin American connection that is helping them diversify away from the tourism industry. And that's something that was mentioned in the Moody's and the Fitch double upgrade that they got. But you can really see it reflect in the markets. I mean, we're looking at a 60 basis point spread to boons. Compare that to France, compare that to Italy. This is wild.
But it is funny you mentioned this parliamentary gridlock, that the PM needs an agreement of 8 diverse parties to pass any law. So essentially there hasn't really been any legislative change since the 2023 elections. Meanwhile, they're having this economic performance that's exceeded expectations. That was Fitch's word in their upgrade on Friday. Moody's saying their economic strength is improving, talking about strengthening even in the banking sector, which we know has been in our minds recently about struggling essentially for the consolidation that the government wants.
Imagine what that economy would be doing if you had political stability and budgets being passed. Now, to the corporate stories and GSK, with a new leader being announced, the CEO of GSK will be Luke Miels, assuming full responsibilities on January the 1st, taking over, of course, from Dame Emma Walmsley, the current CEO. So a new head atop the UK-based drug maker Luke Miels, or Miels, the CEO, assuming full responsibilities on January the 1st. The stock is up about 14% year to date. That is a stock to watch for you come trading at 8 a.m. UK time.
Absolutely, lots to digest there. About 15 minutes time to see how this is received by the markets. Let's tell you what we've got coming up on the show today. Michael Hunstad, the Northern Trust Company president, will be joining the program shortly. Plus, Lawrence Mudkin, the Bank of Montreal EMEA rates strategy head. And, of course, Kareem Shadid, a show favorite, BlackRock's head of investment strategy over at EMEA. All on the markets. Plus, of course, Lizzie Burden is on the ground for us at the Labour Party conference. She has an interview with Ruth Curtis, the CEO of Resolution Foundation. Lots of good conversations coming up on the show.
Yeah, let's get you set up for the risk events on the horizon. As we mentioned, Trump is very busy today. He not only will host the bipartisan congressional leaders in the White House, he's also hosting Netanyahu for a discussion on the war in Gaza. On Tuesday, those Trump tariffs that he announced on Friday will take effect on midnight. And actually at midnight as well, the U.S. government shutdown deadline will loom over Tuesday's trading session. Wednesday, the Golden Week begins out in China, and we have to keep an eye on Eurozone CPI. That'll be coming out on Wednesday. Friday, the big one, U.S. non-farm payrolls, but still questions over whether we get that data if this government shutdown does go ahead this week.
So yeah, go ahead.
I was going to say, what is the print that the market? If we get the non-farm payrolls, Val, what is the number that confirms market pricing that locks in October for the next cut for these markets?
I mean, it's a good thing to ask because a lot of commentators have talked about where the neutral rate is now for the U.S. economy, whether it's even positive with the underlying immigration issues and the demographical changes that are going ahead in the U.S. But if we do look at what is penciled in, at least on the terminal, as the consensus estimate, they are looking at around 50K. Now, last month was around 22. So I think anywhere probably outside of that range would cause some concern that the Fed might tilt more dovish in October.
To mention the whisper number is even lower. It's up about 40,000. That being said, it's still 4 days until some of that data shakes out. But I don't know. What if we don't even get the data at all? Is that the bigger concern here, that we're one data print short? Yeah,
what is the bond market reaction to that? How long do we have to wait for more clarity? Val was saying the focus will be on ADPs then, because, of course, there's a string of data through this week. Here's what else you need to know this morning, though. Europe has won. Congratulations, Europe. Golf's Ryder Cup after a tense. What a competition this was. After a tense final day in which America threatened an unlikely fight back in New York, Ireland's Shane Lowry had the final say. I'm definitely outnumbered here, so I'm bigging up Europe. Sinking a 6-foot birdie for the win. This year's edition of the tournament proved controversial, with the Europeans having to contend with a hostile home crowd. Europe's Rory McIlroy called the behaviour unacceptable and abusive after he was targeted with insults. Moldova's ruling pro-European party, meanwhile, is on track to win re-election, keeping the country on the path to EU membership and raising the risk of an escalation in tensions with Russia. If confirmed, the outcome would be a blow to Moscow, which has allegedly spent millions of dollars and made plans to install pro-Moscow forces in Moldova's capital. And in corporate news, Lufthansa has announced 4,000 global job cuts. The staff reduction is the German carrier's latest move to rein in costs as it pursues a turnaround following last year's slump in profit and margins. Earlier this month, the group said it will consolidate hub airline operations. Europe's largest aviation group is set to hold its Capital Markets Day later this morning in Munich.
Coming up on the program, lots of individual companies to watch. Lufthansa, of course, being one of them. Another, Jaguar Land Rover, reportedly seeking £2 billion of emergency funds. We're going to focus on the funding for the Tata Motors company. Plus, of course, one eye on the Spanish economy and Spanish assets after the country gets a double ratings boost the back of a strong economy. Of course, the debt issue still looming large. Up next, though, speaking of the debt issue, let's talk about the U.S. shutdown. That is less than 48 hours away. Are investors even worried about it? We're going to find out. If you have any questions of your own for our guests or for us, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
I think markets have a reacceleration hypothesis, and I'm sympathetic with that. So I do think the economy will be in pretty good shape for the rest of this year and into 2026 as some of the new administration policies come online.
That was the former St. Louis Fed President Jim Bullard talking about how he has sympathy for the reacceleration theme that's really gripped markets ever since that beat in the second quarter GDP of last week. I have to note, though, we have a lot of data this week to either maybe confirm or deny whether the U.S. economy is still looking good when it comes to the third quarter. We have a heck of a lot of labor market data this week, but the big question still remains whether we'll get that NFP print on Friday if we do have the government shutdown. But we do have the JOLTS on Tuesday. ADP private payrolls, which will come out regardless of whether we have a shutdown or not. It isn't a government data set. We have the jobless claims on Thursday and non-farm payrolls on Friday. But when it comes to where the market is headed early on this Monday morning, U.S. assets are fairly positive. S&P Futures are in the green after we got the confirmation that the bipartisan leaders will be headed to the White House for a meeting with Trump later today. The U.S. dollar is softer after having one of the best weeks in the last 2 months, and those 10-year yields are headed slightly south. But one thing to note is that a lot of this equity market rally has been on the back of the AI trade, not necessarily on the back of a reaccelerating economy, just down to all of this investment spending happening in AI, leading many of us to believe whether the Mag 7 index is really fit for purpose. Some talking about a new index, including Oracle, Broadcom, and Palantir, who have really taken the shine in the last few months.
A lot to digest there, but is there an alternative? I don't know. It's a conversation to have. Let's go back to our top conversation when it comes to what's going on in the States. Talk about this looming shutdown as well. We're less than 48 hours away. We've got a perfect guest for it. Michael Hunstead, president of Northern Trust Asset Management, joins us right here on set. Thank you so much for your time this morning.
Thanks for having me.
Lovely to have you. It's nice to have you visit from the States because I think we need a little bit of an American reality check. We are 48 hours away, less than 48 hours away from a U.S. government shutdown at the moment. What happens if we hit that deadline? What happens if we don't get the payrolls report on Friday? Give us your doomsday take.
You know, our assessment is there's a fairly reasonable probability of a shutdown, but historically speaking, there have been a lot of shutdowns. Since 1976, there have been, I believe, about 20 shutdowns. The average duration is about 14 days. During those shutdowns, there has certainly been equity weakness, but by and large, it's been fairly mild. So when we look at the risk cases around a shutdown, they're pretty benign overall. Plus, when you add to the fact that if you look at the 30 days after the shutdown ceases, you actually have very positive equity returns. So it's not impacting our tactical asset allocation. We do have concern on the labor market front in that if there are layoffs as a result of the shutdown, that, you know, obviously is not well timed. But on the other hand, when you look at federal employment, overall is about 2% of total employment. So not a huge part of the employment picture. Still potentially adding to some weakness on the employment front. Obviously, that's front and center for the Fed right now.
It absolutely is. But even if we do, say, come out of the shutdown in 30 days, which at the moment feels very optimistic, we're right back in this position come Thanksgiving / right before Christmas as well. It feels like these conversations are getting more and more frequent. They're now every couple of months with the same pressing issues. Are we going to have the same conversation in 3 months, Michael?
I think we might, and that's going to contribute materially to equity market, asset market volatility overall. Again, we're not suggesting or discounting the fact that it's going to be a material drag on equity prices. But when you look at the volatility of equities, you know, these kind of things trigger big volatility events, and that's certainly something to take into account for the downside riskier portfolio.
How are we thinking about the fixed income markets then in that environment, given how much has been done on bonds, up about, what, 5% or so year to date? the market's getting it right in terms of weighing up the inflationary risks with a little bit of softness in the labour market, and now some risks and concerns about government shutdowns that, as you make the case, you can look through that to some extent.
Yeah.
But in terms of pricing that all in, are Treasuries looking fairly priced at this point?
You know, I think what this does is it adds to the potential specter of a term premium across the board, meaning that any time that you have any kind of government issue, credit issue, longer-term volatility issues, that's going to impact the risk premium inherent in U.S. Treasuries. Now, when we look at the Treasury market right now, we do see a positive risk premium that has grown over the last several months. Will the government shutdown materially impact that? Our expectation is no. But as these things mount, as Fed independence is also an issue front and center, that will have a positive impact on the term premium, pushing that long end of the yield curve even higher than it is today.
Where do you stand on that Fed independence question? And you said it becomes more of an issue in 2026, potentially. Of course, the Fed chair steps down in, April, I believe. Yeah. How salient are those risks?
You know, I think there is a lot of headline risk associated with this. The reality is something different. Now, in the last Fed meeting, we had, I would say, broad consensus. There was one dissenter, but because they wanted 15.
Pretty notable dissenter.
But in general, the consensus has been for obviously cuts overall. So when we think about Fed independence in that regard, it's really hard to say one governor is, you know, very impactful of the overall Fed position. That's not really realistic. I think overall, again, contributing to market volatility and these headline risks around Fed independence, the reality, though, has not changed our tactical asset allocation at all.
Michael, I see that you've recently added to your U.S. equity exposure. Is that because you think we're in inning one of this AI trade and has still a lot of room to run?
There's a few reasons. You know, when you look at the U.S. economy right now, there's what I'll call fat tails on both sides. There's a lot of downside risks to tariff, to Fed independence. There's a lot of upside risks, and AI certainly is one of them. Are we in inning one? I think we're probably in inning 2 or 3. But the reality is that when you look at AI and technology stocks in general in the United States, this is nothing like the dot-com era. You know, we have the strongest free cash flow and free cash flow margins of all of the equity market in the AI stocks. Highest capital expenditures in general, balance sheets, very, very good. Profit margins, very, very healthy. So if you're betting against AI, if you're betting against U.S. tech right now, you're betting against the highest free cash flow sector of the entire.
Well, I think maybe the bears would argue that regardless of the free cash flow from those hyperscalers, that they're still going to have to borrow a lot of money to fund this investment build out. Does that worry you at all? How they're going to raise this cash?
Yeah, it's a great point. Debt financing is something relatively new to these kind of stocks. But again, when we look at their earnings and their free cash flow positions, that added debt is not a huge concern for us in terms of their ability to pay it off going forward. Their debt to equity ratios in general are very favorable relative to the rest of the market. So yes, there's some staggering numbers out there in terms of the debt accretion on their balance sheets. But at the same time, you know, these are massive balance sheets to begin with.
Is there one part of the debt market you think is likely them to tap harder? Is it going to go into the private market, for example?
There's some possibility of that. I think there's some real possibility of that you see private credit take much more of a front and center stage in this sort of situation. I think it'll be a mix of public and private, but more and more as we see across the entire economy, there's been a general shift toward that private credit segment.
Well, Michael, we're in the second or third innings of AI. How many innings are there? This is baseball, right?
Baseball.
How many innings?
Nine innings.
Nine
innings.
In a regular game, you can go extra innings as well. Yeah.
That's the context.
The playoffs do start this week.
There you go.
Major League Baseball, in case anyone's paying attention. But yes, Michael Hunstead, thank you for joining us, the president of Northern Trust Asset Management. Coming up on the show, why the UK Prime Minister says he's fighting for the soul of the country. We're live at the Labour Party conference next. This is Bloomberg.
Minutes away from the start of the opening trade here in Europe. When you look at the futures picture, you would think all is right in the world. Futures are drifting higher. You're seeing some outperformance on the Euro Stoxx 50 futures higher by 0.5%. kind of the same beat in the FTSE 100, higher by 0.4%. Even the CAC 40 is dancing along to the party. I will say, though, the IBEX is your underperformer this morning, only higher by 0.2%. We'll see if that sustains. But green across the screen in the equity picture, Val.
Yeah, we have our eye on Spain after the double upgrade on Friday from Moody's and Fitch, both citing economic performance exceeding expectations for the Spanish economy. We are seeing a bond rally to start this session. Those Spanish 10-year yields are down nearly 2 basis points, mostly following in line with the Treasury market. Those 10-year yields in the U.S. are down 2 basis points.
OK, to UK politics now, because the Prime Minister, Keir Starmer, has framed his political survival as the country's best hope of defeating populism. Starmer heads into his Labour Party's annual conference, facing questions, of course, about his leadership and pressure in the polls from Nigel Farage's Reform UK. Bloomberg's UK correspondent, Lizzie Burden, is at the party conference in Liverpool for us. Lizzie, is it all doom and gloom on the ground there in Liverpool, or is that overstating it for a Prime Minister who still has more than 3 years left in office?
He still may have all of that time until he has to call a general election, Tom, but the polls show that Keir Starmer is languishing at the moment. If there were an election right now, according to YouGov, Reform would win, not Labour. And you've got many of these new MPs very, very worried, having just got a taste for Parliament, that they could lose their seats. And so the speculation is rife in these conference hall corridors about who could replace Keir Starmer. And just the fact that that speculation is happening is undermining to the Prime Minister. You've got the likes of Andy Burnham, the Mayor of Manchester, openly criticising the Prime Minister, talking about a culture of fear in the party, saying that the government is in hock to the bond market. But more subtly as well, you've got the likes of Wes Streeting, the Health Secretary, criticising the US President Donald Trump. So putting some daylight between himself and the Prime Minister's softly approach to the US President. So in order to respond to this, you've got the Prime Minister taking the fight to Nigel Farage. Just take a listen to what he had to say on the BBC yesterday.
Fight of our lives ahead of us, because we've got to take on reform, we've got to beat them. And so now is not the time for introspection or navel-gazing.
So the Prime Minister saying it's not the time to be talking about who could replace him. He'll have his speech tomorrow, but before that we'll have the Chancellor, Rachel Reeves, who I believe is right behind me.
Perfect timing. Lizzie, speaking of, as we, of course, await her remarks, what do we expect from what she's going to maybe say today?
Well, the Chancellor has admitted that the public finances are in a pretty precarious position. Her words, if you look at the gilt market right now, you've got yields at multi-decade highs. We've just had a string of auctions where demand was pretty weak. And so the questions have been swirling ever since her last fiscal event, the spring statement. Which tax levers is she going to pull? The Labour manifesto said that they wouldn't raise the three main taxes, income tax, VAT or the payroll tax. She's already raised the employers' payroll tax. Will she go for the employees' one? Will she choose to placate the markets or the left wing of her party? We know that the left wing has not been willing to countenance the welfare reforms that she wanted to put through to save the party money. It's a difficult choice here, but our economists reckon she needs £35 billion. Where will they find it? The Prime Minister in the broadcast round yesterday refusing to give a straight yes-no answer when asked to rule out a rise in VAT. We will discuss this with the Chancellor when she's on Bloomberg TV at 9:15 a.m. today. But look, it's a very, very difficult speech she is going to have to make. Again, for her, it is make or break.
OK, Bloomberg's Lizzie Burden, thank you very much. On the ground for us in Liverpool. And, of course, we'll be hearing from the Chancellor, speaking to Lizzie, in about an hour and a half's time or so. Now, there were jitters on the UK gilt markets, of course, last week, ahead of the budget, due at the end of November. Let's bring in Lawrence Malkin, head of EMEA Rates Strategy at BMO Capital Markets. Lawrence, thanks for coming in to the studio. So we're talking about the fact that gilt markets were under pressure last week. Some of the sales, the debt sales, weren't received as well as probably the Treasury would have hoped. But you are seeing maybe some silver linings for the gilt markets. That seems quite counter-consensus when we're thinking about the challenges facing this UK government.
Well, maybe it is counter-consensus, but you've got to think about what is already in the price, what is already known. And I think what Lizzie spelled out is exactly what we already know, which is there is a difficult fiscal situation. It's not clear where the balance of power lies within the Labour Party, which creates uncertainty for the market. But all these things, I think they're already well known, and you would think that investors have priced those possibilities in as well as they can. So when I look ahead and say, what are they going to do? What are we looking for? What is the market looking for? Obviously, we're not going to get detail on the budget today, for sure. But we are going to get mood music, including this, a lot of Rachel Reeves' speeches and this interview and what have you. And some of the mood music is quite positive, I think, for the gilt market. It's about finding ways with taxation rather than with borrowing to address this gap in the fiscal situation. It's about, as you mentioned before, trying to find anti-inflation measures, which of course would help the market expect more Bank of England rate cuts. Not ruling out VAT hikes. I mean, bond markets, I'm afraid, like the money to come from someone else. The bond market would respond well to a VAT hike because it means less borrowing than otherwise.
Bond markets are comfortable with higher taxes. And they'd respond well to VAT being put up.
What are the choices, right? The choices are tax more, borrow more, spend less. I think the bond market, of course, ultimately would like to see less spending. But the one it really doesn't want to see is borrow more. So compared to that, an increase in taxes, and again, there may be a little bit more in the way of less spending.
Yeah.
People like Pat McFadden talking about benefit reform again. This is the kind of thing that upset the bond market when it didn't happen before because it showed an inability to control spending. But it looks like the government's going to have another go at that. Again, the bond market would find that reassuring.
So just to kind of pin you down on this, you position for gilts to rally?
Well, the bits of the gilt market I like most are the very long end and the very short end. So the 30-year gilt, as you know, has been the thing that everybody points to as, look, if you're not careful, things are going to go out of control and so on and so forth. But the supply of long-end gilts is going to fall quite a lot because of what the Bank of England announced recently, what the Debt Management Office announced recently in terms of shifting supply further forward. So that looks all right. Front-end gilts are sold off a lot. Is the next move from the Bank of England up or down? It's going to be down, in all probability. At the moment, I think the front end of the market is discounting very little risk of a downside move in rates.
Lawrence, last week we had Nigel Farage meeting with the Bank of England's Andrew Bailey. They had some discussions on QT and whether they should be paying interest on the bonds that are currently in their portfolio. What did you make of that? Even the fact that we are having a political member meet with the Bank of England governor, and then all these creative solutions, perhaps, that he was proposing.
Yeah, I think the way that the UK has done QE and QT and the way that it's funding the losses from the programme is pretty much unique. Right? So nowhere else is the Treasury reimbursing in real time the losses made by the central bank. There's a strong argument that it really doesn't matter when you reimburse the losses. You either lose the money now or you lose the money later, and in present value terms it's the same. And I think that's the intellectual framework within which the structure was first created of this indemnity. Is it fair to challenge that intellectual framework now, kind of whatever, a decade and a half on? I guess it's fair. Is the argument any weaker for it? I don't think it necessarily is. So, I mean, it's worth exploring, but I mean, I think the structures, the institutional structures, are still very strong in favour of this is the right way to go.
Yeah. Well, in just talking about creative solutions for the UK government to help this budget crunch, debt crunch that is coming down the line, is there anything that would maybe excite the bond market to see the UK government doing? I guess they've kind of towed the line on the traditional practices. But if there was something out of left field that would help the situation?
Well, yeah, I mean, I think... So you're right. So let's ask the question, what really do bond investors care about? Right? They don't care about very much. They care about the present value of their future liabilities. Right? So they worry about inflation. They worry about supply. And also they're quite short-term. They have a 1 to 2 or 3 year horizon, even though they're looking at very long-dated bonds. So if the government could do something to bring down the likely trajectory of inflation faster, that would mean the Bank of England could cut rates more quickly. That would help the term structure a bit. If they say we're not going to borrow lots of money, but we're going to raise taxes, we're going to slow growth, weirdly that's not bad for the gilt market because, again, brings rates down, brings supply down. So those are the sorts of things. Would that be left field for the government to force growth lower? I guess it would be a surprise to us all, given the nature of what this government's trying to achieve, yeah.
How much does more supply on the front end muddy the waters in terms of the picture you're talking about?
I think if it's come from the back end, I think it works. With the lesson we've learned from the US, where obviously, again, government borrowing has accelerated, but an awful lot of it is now in the front end of the yield curve. The back end of the yield curve seems to like it, right? Long yields are much lower in the US than they were, and they've outperformed the UK a lot. Does that lead to more risk? Does that mean that there's more refinancing risk for the government through time? Yes, it absolutely does. But every one of these things is a trade-off. So I don't see signs of indigestion in the front end developing. It's much easier to sell. It's much easier to sell short-duration bonds than longer-duration bonds.
Well, you led me right where I wanted to go, because the argument on the front end of the curve in the States is that this is a moment in time when everyone wants to have less duration risk, basically. Does that still apply to the UK, though?
It does, partly for the global reasons that, liquidity is diminishing globally because of QT, at the same time as governments are borrowing everywhere, so there's lots more demand for money. So, you're in a bigger global competition for funds. It seems that investors don't want this extra duration now because of specific changes into the UK savings scheme. So if you look at what the UK Debt Management Office has done, it's responded to this, right? It's reduced the level of long gilt sales as a percentage of total sales to the lowest level, I'm going to say, for 12 years or so. It's maybe since it started. Because, the demand dynamics in the UK market have changed and it's responded. Likewise, the Bank of England in its QT programme is cutting the proportion of long gilts it's doing. So I think, you can see from the borrower side or the issuer side, they are responding to changes in demand dynamics, and that does force more paper into the front end, but that is where it can be more easily absorbed, I think.
Well, Lawrence, what about somehow the government trying to change the demand dynamics? Could they do some pension reform that would make pensions buy more long-term gilts or something of that manner?
They could. I mean, one of the weird things, which we just touched on, is that as it happens, long-term savings in the UK are moving from a regulatory regime which really mandated gilt buying to one which which has gilts as just one of a number of possible investments for insurance companies. I suppose reform of Solvency UK to encourage the UK savings industry to stay with long gilts or buy more long gilts would generate demand that way, in the same way that you could change bank capital adequacy rules to make gilts more attractive for banks. So those are possibilities to increase demand. Are they nearby? Are they a long way away? I think the pensions one is a long way away. The banks one is probably easier to do and probably more likely to come, but is also not tomorrow's story, I think.
All right. Lawrence Mutkin, head of EMEA Rate Strategy over at BMO Capital Markets, walking us through some of these dynamics in the UK. We thank you so much. We're going to be heading back to Liverpool later for an interview with UK Chancellor Rachel Reeves coming up at 9:15 a.m. UK time with our very own Lizzie Burden.
Well, coming up, M&A in the pharma space. Denmark's Genmab is to acquire cancer drug maker Merus. We'll talk about that and your other stocks to watch next. This is Bloomberg.
About 13 minutes away from the opening trade. Green on the screen across the board, really seeing some outperformance in the DAX this morning, higher by about 0.6%. I stand corrected. The CAC Rot this morning, higher by 0.6%. They're both kind of neck and neck for the winners this morning. Absent from that board, though, is the IBEX, which is actually underperforming from the futures picture, but still green on the screen. We'll see if we get a little bit more action at the opening trade, because on Friday, Moody's and Fitch upgraded Spain's credit ratings, both firms raising their assessments by one notch. Despite the political instability, Spain's growth has, of course, outpaced Europe's other big economies since 2021. Bloomberg's Daniel Bastero, our Spain correspondent, is all over this story. Daniel, pleasure to have you on the program. Spain's credit rating was one notch above junk during the euro area debt crisis. Why or what got it to this point?
Well, much has changed, hasn't it? The Spanish economy is outpacing now other major euro economies. 2 2.7% growth in GDP terms is expected for this year, for 2025, compared to the 1.2% of the euro area. Unemployment is in a record low since the financial crisis, and public debt has gone down significantly. It hits 124% of GDP right after the COVID pandemic, and now is at 102%. So Fitch, Moody's, and Standard & Poor's a couple of weeks ago, who also made an upgrade, have brought now their assessments to the highest level actually since 2012. And this is, of course, the product of many elements. First is tourism, also non-touristic exports, the strength of the banking sector, and private consumption, household consumption, that are well explaining some of the figures we've seen that are much different from those we were used to report on from Spain.
Daniel, the one thing that really stands out, though, about Spain is the fact they have a parliamentary gridlock. They've had it since the inconclusive elections back in 2023. Do you see that this economic boom is happening despite the political instability or because of the political gridlock?
Well, I'd say definitely despite. Spain doesn't have a budget approved since 2023. So this term has been run with a budget approved in the previous term for 2 years now, and the Spanish government has weak parliamentary support. It depends on more than 8 political parties to pass any law, which makes life very difficult for the Prime Minister in Parliament. But the economy is doing well, as we see. It seems to be a decoupling between the political situation in Spain and how well the economy is doing.
OK, Bloomberg's Daniel Bastiero, thank you very much indeed on the upgrades for Spain and the economic health of that economy, that country, despite that political instability that we continue to see, of course. Let's bring in at this point Paul Dobson, our executive editor for Asia Markets. Paul, we haven't touched on the China data yet because it could have been a strong set of data when it comes to industrial profits, and the equity market performance continues to push higher in mainland China and Hong Kong. Paul, what are the future catalysts? How are markets adapting to the reality on the ground in China?
Yeah, hi, good morning, Tom. So with plenty of enthusiasm today and for most of the recent months as well. We've got a 2% gain more or less on the Hang Seng so far, gains in the mainland stocks as well. People are looking at the numbers for industrial profits over the weekend, which showed a big jump, a much stronger profile than in recent months, seeing the benefits of China's anti-involution program starting to come through, where they're trying to reduce hostile cutthroat competition in the mainland in order to allow companies to make a profit, increase their margins, essentially. But that's just a tiny part of the bigger overall picture where, China is starting to really register again in the international investor shopping list. People are paying attention because they like these reforms in the markets. They also like the fact that China is showing much more exciting kind of growth in terms of AI, robotics, other high technology stock market companies. And on top of that, some of the political face-off between Presidents Trump and Xi is also starting to fade. And so we're seeing investors that have been staying away for 4 years, ever since we had that big crackdown, which you'll recall, Tom, on the property sector, on the financial technology sector. That's all starting to fade away. And because the market is so strong, even those investors that hadn't previously paid attention are being forced to capitulate and join in on that rally. We've got a holiday coming up in a couple of days' time, so people want to get in there before the market's shut.
Paul, speaking of getting in there before the market shut, we're talking about a government shutdown on the other side of the Pacific there when it comes to the United States. Yeah. There's also a question of, should a shutdown hit in less than 48 hours? Do we get jobs data come Friday? What is the market reaction to no data at all?
Well, that would be interesting. I mean, that will put a lot more weight on the private indicators like the ADP, which we still will get for the jobs data. But really, the market has been looking to these numbers to really clinch the Federal Reserve interest rate decision that we get at the end of October to give us a stronger gauge of whether they will act with another cut 2 months in succession. The jobs data has been the key factor the policymakers angling for cuts have been leaning on. So without that information, it's going to make it very hard for us to tell what the path will be from here.
Paul, what do you think of this rally in gold this morning, up 1.5% to start Monday?
Yeah, gold just continues to go from strength to strength. Not just gold, but the miners as well. We've got some IPOs coming through, which are looking strong too. The market is really leaning into that, leaning against currencies as an alternative asset. You know, it's still hot. China continues to buy, and that's driving the market higher.
All right, Paul Dobson, our executive editor for Asia Markets. Thanks for joining us on your thoughts on the market. Now let's get our stocks to watch ahead of the European Cash Equity Open with Chloe Melly. Chloe?
Good morning, Valerie. Let's keep an eye on Spanish banks today after that double upgrade, and Moody's and Fitch for Spain, which really confirms the country's spot as a top economy in Europe. So we could see that movement here in that Spanish banking sector that's already been doing so well, as well as outperforming its peers. As well as you can see, both BBVA and Santander, the 2 biggest banks, doing much better than that broader bank index. Moving on now to Genmab, a pharmaceutical company that is buying Merus, another pharmaceutical company that is developing a treatment for head and neck cancer, and that could be potentially a blockbuster drug with $1 billion in sales by 2030. So this could extend this rally in shares that we've seen for Genmab. And finally, let's end with another Danish pharmaceutical company that might not be doing so well this morning, Novo Nordisk, which got downgraded to an underweight rating at Morgan Stanley because of weaker prescription growth in that GLP-1 space, as well as higher competition. It's worth remembering it is only 2 sales at the moment, so it's still a little bit...
Right. Our equities reporter, Chloe Melly, walking us through those stocks to watch. The opening trade is next. This is Bloomberg. A few minutes to go until the opening trade. Let's see how we're set up for this Monday trading session based on Friday's trade. We kind of ended on a positive note. Friday feeling, I think, is what we're going to call it. You saw that both the European session and then the American session as well. So perhaps a little bit of good feeling, perhaps just waiting for some of the catalysts of this week. Val, how are we set up going into the opening trade?
Well, let's call it a Monday feeling, Kriti. Fairly positive to start this Monday and fairly even across the board when it comes to futures across the continent. Euro Stoxx 50 futures up 0.5%. So is the FTSE 100 and the DAX futures to start this Monday's trade. Tom, what stocks are on our mind at the open this morning?
We're looking at Spanish banks on the upgrade that came through on Friday, a double upgrade for Spain. The economics, of course, of that country proving pretty resilient in terms of being an outlier, in fact, across the Eurozone. Growth of around 2.5% is what is forecast, well above the around 1.5% for the rest of the Eurozone. So we look at the upgrade there in terms of the read across for the Spanish banks. GSK, we've got a new leader being installed on January the 1st, new CEO, as Emma Walmsley is set to step down. A new CEO being appointed then for GSK to take the helm from January the 1st. So we watch that stock as well. And Lufthansa cutting around 4,000 jobs, most of them in Germany. They're targeting 8 to 10% adjusted EBIT margin for 2028 to 2030.
Lots going on there. We'll see how it reflects in the broader kind of index level as well. You mentioned GSK, perhaps that kind of UK tech company feeling will actually show up in the FTSE 100. Remember, they has been not the outperformer this morning. You've seen the outperformance in the DAX and the CAC 40 as well. The IBEX firmly in focus because in the futures picture, we did see a little bit of underperformance there, only higher by 0.2%. It wasn't in line with the rest of the market. I wonder how much of that simply is a reaction, perhaps, to what we saw on Friday. Perhaps something else. Well, here it is, the opening trade. We'll put all of our theories to the test here this morning. When you come back to the open, the FTSE 100 already tilting into some positive territory. We'll see what the outperformer is because, again, it is Monday. We have to wait for some of these trades to shake out. We've got a couple of individual stories, not enough geopolitical volatility in the news flow when it comes to this morning, but the stock 600 higher by 0.2%. We're going to wait for the rest to kind of shake out. But again, I have my eye firmly on the IBEX, Val.
Let's take a look at the sectors on the move in the first few minutes of trade. Fairly positive. We have 17 sectors in the green, nearly 18 in the green, 2 in the red to start trade this morning. At the top of the basket, I see basic resources. We also have technology up there. I'm wondering if that's on the back of Morgan Stanley upgrading Alibaba overnight. At the bottom of the basket, we have energy, also telecom down there, but I'm also keeping an eye on how those Spanish banks are faring. The bank sector as a whole is opening up pretty positively, though, at the bottom of the green list of the sectors.
OK, so the FTSE 100 up 0.3%, adding 29 points at 9,311. Over in France, a similar picture with gains of 0.3%. Still wait for the DAX to reflect, of course. Currently, in terms of some of the individual movers, I'm looking at Lufthansa. Let's wait till we get a proper pricing on that after the job cuts of around 4,000 that have come through. GSK is currently up around 3%. We have change at the top, of course, of that UK-based drug maker, CEO Emma Walmsley to step down, and the Chief Commercial Officer, Luke Miels, to take over from January the 1st. In terms of some other movers in focus for us today, Ørsted, of course, the wind turbine maker, up 2%. In the pharma space, Zealand Pharma gaining a little over 2%. And on the downside, as I quickly refresh what's happening in terms of some of these individual names to get the most accurate pricing, we're looking at some pressure coming through for the likes of Stellantis, of course, the car maker, down 1.3%. Some of the individual names on the move. Novo Nordisk also a little softer by 1.5%.
Lots to digest there in terms of those index movers. It's kind of interesting. You are seeing a tale of two healthcare stocks that I think seem to be driving the story. GSK on the upside, Novo on the downside. Is today just a micro story? That's kind of what that feels like today.
Well, we're not seeing, at least on the macro picture, we're not seeing any positivity feed through from Spanish banks, from the double upgrade from Moody's and Fitch on Friday. Some of those names actually in the red, and some of the worst performers in the banking sector. Banco Sabadell in the red this morning. So perhaps it was already priced in, the double upgrade that we did get from Spain, but still a lot of positivity around the economic outlook for the Spanish economy. Joining us around the table now is Karim Shadid, the head of EMEA investment strategy at BlackRock. Karim, is the global economy about to reaccelerate?
Thanks for having me. I mean, when we look at some of the data that we've seen the past couple of weeks, of course, the big narrative was about soft landing the last time I was here, and it was about the weaker labor market in the U.S. And that started to change with some of the numbers we've seen the past couple of weeks, whether it's some of the PMIs and ISM indicators or the broader macro data. And so when we look at the market pricing, talking about the U.S. economy here of the Fed path, that has started to move a bit. And we're no longer at that sort of full 5 cuts priced by end of next year. We've started to see a bit of a pricing out of cuts from now to year end. And so perhaps we lean into this idea that the Fed pricing was a little bit too dovish, and the adjustment is something that we're leaning into.
Well, in terms of how you're looking at your portfolio, with this backdrop of at least a very strong second quarter GDP growth in the U.S., how do you see that positivity faring for Europe, who, for some reasons, it isn't necessarily exposed as AI trade, which has grasped a lot of the U.S. equity market's attention?
Sure. So quite a different picture for Europe. I mean, when you look at the European growth inflation mix and what the considerations for the ECB are, the ECB already at 2%. We're not expecting any big moves from them between now and year end. There could be one more cut going into next year. But if it does happen, it would happen because of the weaker growth, not because of declining inflation. So inflation has already fallen in Europe. There's a bit of stickiness left, and there's some risk of small reacceleration. So really, we're looking at the weaker growth picture being the big driver here for Europe.
But is there to build on Val's point, is there an AI premium in some of these stocks? And I ask that because, and Thomas covered this quite well in his Bloomberg Technology show, or Bloomberg Tech show, that the adoption process of AI is stronger in Europe because the U.S. and China and other players are focused still on the technology, but the adoption is faster in Europe. You're seeing that in financial institutions, for example. Is that something that gets priced in?
It's a great point, because so far the big opportunity in AI stocks, and we talk about the AI tech stack. We look at the AI stack right from the infrastructure, where a lot of the moves have so far been really focused on this infrastructure build out because of the breakthrough that we saw last year. through to the adopters, which, to your point, you look at some of those big European sectors, whether it's the financials or others, consumers, and they can make a big difference with AI adoption. But this is where dispersion is key. So we talk about the opportunity in AI adopters as well as in European equities as a selective opportunity, where you need an active manager who is able to decipher who are the winners and who are the losers here based on those who are actually putting in things in the process of the company to benefit from AI, and those who are just talking about it but are not following with action. This is the dispersion that is important, which is why there is an active opportunity in European equities with that AI adoption lens.
It's fascinating because on the one hand, if we're talking about we had a guest on in the last hour talk about the fact that if you want tech exposure or if you don't want kind of the AI exposure, you just can't take out U.S. tech and the AI story. And then in the same vein, you would take out free cash flow as well. He kind of melded all those subjects together. Does that apply to the mega cap stocks, I should say, not tech necessarily, mega cap stocks of Europe? That if you want to outperform in this market, you have to look for the ones with the most free cash flow and the most liquidity. Is that the same roadmap?
So actually, I would make a distinction between how we're investing in U.S. stocks and European stocks. In U.S. stocks, it's very much what you just laid out. Free cash flow yield is king. Quality tilt is king. That pays in the U.S., which is why we're overweight U.S. stocks. We are focused on the AI names, we're focused on the tech story and that quality tilt. In Europe, we see that actually value pays. So tilting towards companies that offer cheap valuations based on historical metrics and that have good profitability stories. That is the approach in European stocks that pays the most, which is why we're most positive on areas like the banks, financials more broadly, obviously industrials, which have already seen good performance numbers, but we're leaning into those momentum areas in European stocks.
As you look at the geopolitical changes that we've seen in the last few weeks and Russia's attempts to intervene, airspace, Estonia, Poland, how are you thinking about the industrial story then? And when you've combined a picture around the fiscal stimulus story that comes out of Germany,
sure,
and then that re-emphasis on the need to build out defence capabilities. When does that? Where are we in that journey in terms of wanting to get exposure to that?
So when we think about that journey, first of all, we have to highlight that there's already been really good performance from industrials, and specifically the defence subsector of industrials in European stocks, which is why I'm calling it a momentum area. Because actually, when you look at momentum factors, that's the one that really leads the pack, and because it's been a very good performer. But we're leaning into that. The main thing we're watching out for is future earnings. So you look at the Q2 reporting season, and the big theme in European stocks for Q2 earnings, which just wrapped up, was the strong euro hurting the exporters. That was the big story, which is why you end up with earnings for Europe at 0.5% flat, basically. There hasn't been really good earnings in Europe, unlike the US, where we're still in double digits. So as we move forward from here, we focus on those domestic leaning stocks like industrials, like defense. And we look at those dividends of the German fiscal stimulus starting to hit their earnings, starting to show up positively in their earnings. That is the next signpost for us.
So, and on the euro, then, that is making an assumption that euro strength continues. That's where you want to focus on domestically focused stocks.
Sure.
Does that continue to be a headwind for European earnings?
Sure, it continues to be a headwind for the exporters, which is why that preference for the domestics. Remember, the domestic and the exporter parts of the stock market already had a 25% dispersion between them year to date, but that is why that trend could continue if that euro strength stays.
Karim, how are you viewing UK assets at the moment? Now we have this Labour Party conference ongoing. We're set to hear from Rachel Reeves in just over an hour's time. They're positive or negative catalysts for you on the horizon?
So if we step back and basically zoom out and look at the UK equity picture over the past couple of years, what we need to say is that investors, foreign investors, so non-UK investors, did start to buy the UK equity market last year. And that was the first big amount of flows coming back into UK equities end of last year, early this year. In about 6-7 years, we hadn't seen any foreign demand into the stock market. So this was coming up from a very low base. That trend has now sidelined the past 6 months. So we're not continuing to see that positive momentum because I think foreign investors are struggling to see a very positive catalyst. However, there are positive stories stories in UK stock market. When you look at the large caps, which are mostly internationally focused, the sector makeup does look favorable in today's market environment. So there are opportunities.
Karim, what do you see as the biggest risk event in the fourth quarter?
So I think the main thing we focus on is really that inflation picture. So disinflation was a big theme in the US, right? And if we start to see some inflection in inflation numbers, I think that can disrupt some of that narrative around inflation down and soft landing driving Fed easing. That inflation inflection could disrupt that.
Yeah. Well, Karim Shadid, the head of EMEA investment strategy at BlackRock, thanks for joining us this morning.
Lots to digest there. Let's take a quick look at some of those mega cap stocks that Karim was talking about in this segment. The core six, as Guy likes to call it. You are seeing a little bit of the tech trade get a little bit of love. Schneider Electric is your outperformer this morning, higher by about 2%. Not too shabby for a grid, basically. Novo Nordisk, though, is your underperformer. And I think, Val, you pointed out, down about 7 straight sessions in a row. Also taking a hit this morning, down about 3%. Let's get a check on some of the other individual stocks on the move. Chloe Melly has that for us. Chloe.
Good morning, Kriti. So let's start with Novo Nordisk. That is down this morning 2.8% on the back of a downgrade by Morgan Stanley that noted that weaker prescription growth for its GLP-1 drugs, as well as higher competition from big rivals like Eli Lilly, of course, but also generic competition. Novo Nordisk has been having a bit of a tough time lately. It is worth noting it only has 2 sell ratings, including this new one from Morgan Stanley. So there is still that confidence in the stock, but this is obviously a little bit of a setback for the pharmaceutical company. Moving on to another pharmaceutical company with GSK that is up this morning 3.4%. There's a change at the top for GSK. So the CEO Emma Walmsley is stepping down and will be replaced by Chief Commercial Officer Luke Miels, who's been trying to really build that oncology portfolio for GSK. And it seems that this change at the top is being received well by the market, and there's a vote of confidence for the new CEO who will be starting in January. Moving on to Stellantis, where we have another change at the top here as well, but that is this time not being received that well by the market. We are down 1.3% for Stellantis after the CFO is also leaving. So that's a change at the top for a company that's been dealing with quite a lot of weakness, a lot of tariff-related challenges, as well as just a general slowdown in the car market. So a little bit of weakness for Stellantis today. And finally, let's end with Rentokil, which is a pest controller. It was initiated a sell rating at Berenberg that noted continued issues with its integration of Terminix, which is a company that makes termite control. That's a deal that has been dealing with a few issues, and we are down on the back of this downgrade this morning.
Chloe Melly from our equities team, thank you for the update on the movers this morning in the European market. Well, coming up, we'll discuss one of those. Lufthansa says they'll cut thousands of jobs across its brands to improve margins. More on that story next. This is Bloomberg.
Welcome back to the opening trade. About 16 minutes in today's session. Green on the screen across the board. I will say, though, not with as much fervor as perhaps we were seeing in the futures picture. We'll see if that shakes out. The FTSE 100 is now your outperformer, higher by 0.5%. It feels like a day where individual stocks are making the biggest moves. Let's go to one of them that have caught our eye this morning. Europe's largest aviation group, Lufthansa, says they'll cut 4,000 administrative jobs by 2030. For more, we're joined by our global aviation managing editor, Benedict Camel. Benny, just walk through the details of this announcement.
Good morning. So Lufthansa announced this morning as part of a capital markets day that the company is holding in Munich. It's the first time in a couple of years that they're really providing a comprehensive update on their longer-term goals. And as part of that, the company said that they want to cut, as you said, these 4,000 administrative jobs. This isn't going to happen overnight. It's over a period of several years. The target is by 2030. And really, it's the backdrop is that the company says we are essentially too complicated, we are too bloated. They want to improve this via measures like automation, generally sort of improving the processes. And this is because the company really has too high a cost base, has really struggled to meet its targets. So the hope is that these cuts will help them get to their new goals.
Benny, what else are you and the team watching for when it comes to the capital markets event that takes place for Lufthansa today?
So there's a couple of things, and sort of hanging over all of this like a sword is the strike that is pending. So the pilots are threatening to strike, and we might get an update as soon as tomorrow. So that's something that's on people's minds. You know, you can cut costs as much as you want, but if your aircraft are on the ground because people are striking pilots, that's not going to improve your cost base at all. But in terms of the targets, the company said they want to keep their dividend policy in place. They've got a slightly more optimistic margin target of 8 to 10% in terms of the adjusted operating margin. And all of this is, again, for 2030. They have a cash goal. They want to renew their fleet. And again, that's one of the things that's really held the company back. They have a lot of new aircraft coming in, particularly the Boeing 787 Dreamliner. But that's a plane that's been parked in the US because they don't have certification yet for the seats. So that's really slowed things down for them. So sort of the general renewal of the airline, that's going to be one of the big themes today as this capital markets day unfolds.
Benedict, I noted that Lufthansa did cite the increased use of AI leading to greater efficiency. Do you think that this is a symptom that many others in the airline industry share, that perhaps with the broader use of AI, they can downsize their workforce?
That's certainly going on to some degree, and we know that airlines are acutely, probably across the entire global corporate industry, are looking at how can we use AI to improve some of our processes. For instance, how can we get a better sense of what the passenger really wants and what they don't want? How can we be more efficient? A lot of what the airlines do is still very labor intensive, in the cabin, on the ground, on the airfield. So really cutting back dramatically in terms of AI or using AI to cut back, that's a question for the next couple of years. But certainly here and there, it's going to help them. And that is sort of one of the buzzwords that surely will float around at this event today.
All right, Bloomberg's global aviation editor, Benedict Campbell, thank you for joining us on the latest on Lufthansa. Now let's change a focus to the pharma industry. Shares of GSK are higher on the news that the company's CEO, Emma Walmsley, is stepping down after almost 9 years at the helm. She'll be succeeded by the British drug maker's chief commercial officer, Luke Miels. Joining us for more on this is Bloomberg's health reporter, Ashley Furlong. Talk to us through this succession plan. Is this something that had been in place?
So Miels has long been thought of as a potential successor to Walmsley, and he'll be taking over in January. So it's a pretty orderly transition process with Emma still at the helm for the next couple of months. She's been under quite a lot of pressure over the pipeline, concerns from investors about whether there are enough blockbuster drugs coming to market over the next couple of years. And obviously, pharma industry is feeling a lot of pressure with Trump in the US in terms of concerns about potential tariffs and drug prices. So this is obviously seen as a chance for a change with GSK. Walk us through the headwinds here. What does Luke Miels, am I saying that right? Miels, thank you. What does Luke Miels now have to tackle first and foremost? Centrally will be the pipeline and making sure that investors are confident that the company has a wide range of drugs that could be potential blockbusters coming to market in the next couple of years. GSK wants to get to 40 billion in sales by 2031. Analysts are not quite sure if the current pipeline could get it there. So I think there's really concerns about whether it's going to reach that target.
From GSK to AstraZeneca then, because we have some news in terms of listing plans, and now this is a UK drug maker looking to list, to keep its listing here, but list in the US as well. What is the rationale behind that?
It wants to get more global investors, and I think that's also very much about potential acquisitions in the future, and you know, the idea that having a full US listing will make that more attractive in terms of attracting those investors and making that process easier.
Actually, we've also seen shares of Novo Nordisk decline nearly 2% in the session yesterday off of a downgrade from Morgan Stanley. The stock is down 7 days in a row, lost some 13% of its market value. Is there a real turnaround plan in place for Novo now that these drug tariffs exist that are coming into place possibly on Tuesday night at midnight for the U.S.?
I think for Novo, it's very much around
internal problems, not necessarily, there's obviously a wider context in the US, but Novo's is really around, ensuring that they are doing their internal turnaround, that they are, cutting costs and improving efficiencies under the new CEO there as well. So a lot of changes in the pharma industry.
OK, Ashley Furlong, Bloomberg Health reporter on GSK, AstraZeneca, and the challenges of Novo as well. Thank you very much indeed. An important update, of course, from the pharma space in terms of some of the moves as well coming through for GSK, and stocks are up on the change at the top, at least coming from January the 1st for the new CEO.
Well, speaking of cutting costs, as Ashley was just talking about, we know that one place of the market that's having a hard time cutting costs is clearly governments. UK, here in London, struggling to do that. And same with the US as they approach this government shutdown, which is, I lost my countdown clock, but 45 hours away now, Kriti?
Yeah, less than 48 hours away, I think, is a safe bet to say. And there's a big question here of whether we're actually ultimately going to even have some sort of Hail Mary agreement. And maybe that's why we're seeing the markets a little sanguine around this threat, because there's always an 11th hour agreement. Is this time different? Perhaps. I had a really interesting conversation last week with a credit investor that was making the case ultimately that, and I think we've had this conversation on the show a couple of times, that corporate credit is actually better to invest in, and it gives you more yield for less risk, because that's how little faith people have in government debt right now. And I thought that was really interesting. It kind of took me back to this idea of during COVID, when you had the Microsofts, the Apples, the Amazons of the world issue at ultra low rates, near treasury level rates, because people thought the cash flow of these mega cap tech companies was actually more sustainable and juicier than the U.S. government. And I thought that was interesting, because we're kind of seeing a repeat of that with all these fiscal worries around the world.
Maybe the Treasury market will start tapping the private credit market for liquidity?
Well, companies like Oracle as well, with that massive issuance, which is a trend that I know you looked at in detail, Val. Treasuries are bid right now. Yields are down currently between 1 to 3 basis points at the long end of the curve. The 30-year yields down almost 3 basis points. Gilts also bid as well, so there's some money moving into the sovereign debt of the UK. And we're going to be talking more about the UK, of course, as the Labour Party conference gets underway. Prime Minister Keir Starmer to speak. Rachel Reeves later today, of course. We're going to speak to the CEO of the Resolution Foundation think tank on the UK economy, live from the Labour Party conference in Liverpool. So Lizzie Burden's on the ground for us. We're going to hearing from Rachel Reeves, of course, the UK Chancellor, 9:15 a.m. UK time. So all of our viewers should make sure they stay tuned for that. And we've been talking, and Lizzie's been framing it for us in terms of the challenge for this UK government, caught between their backbenchers and the bond markets.
Go for it.
Yeah, no, I mean, I think that at least what we've seen recently in the press that has really stood out to me is the parallels between what's going on in UK politics to what happened in US politics, where you had the Democrats calling Trump racist. And in doing that, they alienated some of their voters who were potentially thinking about switching parties. So you see that kind of analogous situation going on here. But we do have to talk about the gilt market, because it's the most sensitive thing to these kind of political developments. And really, if they keep with these fiscal rules that Rachel Reeves keeps banging on about, it is really hard for them to get out of this trap, because they need to generate growth. They need to grow more than their interest rate, but they're having a hard time doing that while inflation is still above target and the Bank of England has to hold rates this high.
Yeah, it's fascinating. We're talking about this in the US and the UK. We should also just highlight to everybody that in the next couple of weeks, we have a French budget that's meant to go through Parliament as well. So this entire conversation about fiscal sustainability and raising funds is going to show up in the French market as well, which is seeing a little bit bigger of a reaction function. The worries in the bond market, though, aren't reflecting in the same way in the FX market. I thought that was interesting. 134 on the pound this morning, or on cable, I should say. 117 on euro dollar. So the sell the dollar theme kind of permeates throughout this entire conversation.
Strong session, as you say, for the pound, up 0.3%. We're going to get more on the UK coming up with conversations, of course, from Liverpool and the Labour Party conference. Stay with us. This is Bloomberg. Happy Monday. This is the opening trade. We are 30 minutes into today's session. You're seeing strength across European equities, really pronounced here in the UK. FTSE 100 up 53 points right now, up 0.6%. Healthcare as a sector is near the top of the list on the sector-by-sector breakdown. Across the benchmark, European stock 600, gains of 0.4%. A decent session over in Germany and in France, gains of between 0.3% and 0.4%. Kriti, what are you looking at?
Well, we're looking at a broadly positive session, really reinforcing the themes that you just outlined as well. But take a look at this. It's coming with higher volume, only higher by 2%, but still, we'll take it because it's slightly broad gains here. And it would suggest on the surface, perhaps a little bit of conviction in terms of the bid you are seeing today. 109 of members of the Stoxx 600 are lower, though, so with a grain of salt. I want to highlight one 52-week high. BAE Systems is hitting that metric this morning. That continued bid into defense, you do see it. And this is, I think, a fantastic example and stock chart of that theme, Val.
Well, equity markets on the front foot, and here's what else you need to know this morning. President Donald Trump and top congressional leaders are set to meet to discuss a short-term spending bill to avoid a government shutdown. While Democrats are insisting on health care provisions, Republicans want those issues addressed later. A potential federal government shutdown on Wednesday threatens to delay the release of a key jobs data this week. President Xi Jinping of China is renewing a push for the U.S. to change a decades-old phrase describing its stance on Taiwan independence. According to sources, China has asked the Trump administration to officially declare that it opposes Taiwan independence. The U.S. has not made a decision regarding the demand. And lastly, India's Economic Times reports that Jaguar Land Rover is seeking a £2 billion loan in emergency funding from global banks. This comes as the UK's largest car maker tries to ease the financial impact of a cyber attack that halted production. The latest funding is sought is separate to a £1.5 billion loan provided by the UK government. Tom?
The Jaguar Land Rover story is remarkable in terms of the impact of this cybersecurity event, not just on one automaker, but global supply chains, to the point where the UK government has to step in with a government-backed loan, and now reports out of India that this company is having to look for additional liquidity. It just really reminds everyone, I think, of the cybersecurity challenges at a corporate level. We've had so many incidents of this, but none that I can think of this year that have had such a dramatic impact on a balance sheet of a corporate maker. This is the most important and most significant automaker here in the UK economy. So that is something to think about as well, the cyber security risks of some of these corporates, and that challenge is not going away. Let's think about politics, though, and this ties in terms of the political support that's come through for this key, of course, provider of manufacturing jobs in the UK. And bring in UK correspondent Lizzie Burden, who, of course, is at the Labour Party conference in Liverpool. Lizzie, though, I expect that your focus is more on the political travails of the Prime Minister, Keir Starmer, and maybe what we're going to be hearing from the Chancellor, Rachel Reeves, who's been doing the rounds, but is importantly and most importantly going to be speaking to you shortly, Lizzie.
They're just a warm-up, Tom. Of course, we're going to be speaking to the Chancellor at 9:15 a.m. London time, right here on Bloomberg TV. But before that, I'm pleased to welcome the CEO of the Resolution Foundation, one of the most influential think tanks here in the UK. Ruth Curtis, thank you so much for joining me this morning.
Thanks for having me.
Of course, in a former life, you were Director of Fiscal Policy at the Treasury, so you're in the perfect position to tell us just how tight a squeeze is the Chancellor in.
So it looks like the Chancellor's in a really tough spot. We know that changes in policy have cost since March. We know that the cost of borrowing has gone up. And it looks like, in addition, the OBR will downgrade their assumptions for medium-term growth. So all in all, that leaves her needing at least 20 billion of tax rises and maybe much more.
In terms of what she's going to do, some have said that the Chancellor's too influenced by Treasury officials, your former colleagues. Is that how she's seen, as a very obedient Chancellor within the Treasury?
No, I don't particularly know where that comes from. The Treasury is a department that serves whoever the Chancellor is, and I think I've seen her be quite decisive when she needs to be.
So the speculation is that in her speech today she's going to hint that she'll lift the two-child benefit cap. Is that fiscally responsible?
So we think lifting the two-child benefit limit, which is the limit on welfare payments when a family has more than two children, is really important. Child poverty is forecast to reach a record high this Parliament without it, and it's actually the most cost-efficient way to address child poverty, which is something the government has said it wants to do. Now, I do agree with you, that would need to be funded. We'd made a specific tax proposal for how it could be funded, but it's not out of bounds a possibility to find the money.
Yeah, you've proposed that she should raise income tax by 2p, which would be against the manifesto, but also cut national insurance by 2p. Do you think that's politically viable?
She's in a really tight spot, and I think we need to think about what's right for the economy as well as what's politically viable. Employment in this country is taxed much higher than other forms of income, and we think that's simply not fair, and it disincentivises work. So that's why we've proposed the specific changes to income tax and national insurance. That means it wouldn't hit workers' pay packets, but it would ask people like pensioners and landlords and the self-employed to pay a bit more.
You've also suggested that the Chancellor should increase headroom against the fiscal rules. It's been just shy of £10 billion at the last two fiscal events. It's left her open to this constant speculation about which taxes she's going to raise. Doesn't that seem like an economist's dream but a politician's nightmare?
So look, I think it's a completely fair question. If the hole she's facing is as big as some of the speculation, then it may be not possible to increase her headroom. I think in that situation, I would say she could still give us a sense of her tax strategy, of what she might do in the future, which would mean we're left less with a kind of blank piece of paper and the uncertainty that hangs over the economy. The only thing I would say is if she doesn't increase her headroom, then we could be back here next year, and that would also be pretty politically uncomfortable.
But we could be there anyway, given the fragility in global bond markets. What's to say that she wouldn't have to come back a third time for higher taxes and more borrowing?
So look, you're right that there's no number that can guarantee that however the world changes, we won't have to come back. But one way of thinking about it is, what's the typical variation between forecasts? It's about 0.5% of GDP, about 15 billion. So to have less than that is to have, no more than one bad roll of the dice.
Well, to try and avoid this market instability, one thing that the Chancellor said this morning already is that she would be open to the IMF's advice of just having one Office for Budget Responsibility forecast per year. Is that a good idea? Isn't that a bit like when Liz Truss sidelined, in Rachel Reeves' words, the OBR?
So what Liz Truss did was announce a bunch of tax cuts without an OBR forecast. I think this is a very different sort of discussion, and so we should be clear about the distinction. Equally, the IMF didn't say we shouldn't have two forecasts. They said they supported her ambition to have one fiscal event, and maybe there are ways to adapt the forecast to achieve that. I think those sorts of options are things you might want to look at, but we've had two forecasts in this country since 1975. I'm not sure the right response to the kind of fragility we're seeing in the gilt market is to have less transparency about our public finances.
OK, because indeed the OBR boss does say that this would make Britain less transparent when it comes to the fiscal picture. Another of your proposals is that the Chancellor could raise £3.5 billion from a tax on salt and sugar. And I'm worried about whether that would add to food inflation, aren't you? Because the Bank of England is saying that food inflation spike is what's keeping inflation sticky. So how would that work?
So I agree with you. I don't think this is something you would introduce quickly, and I don't think she should take measures that increase inflation in the very short term. And so equally, a sugar and salt tax would take time to come in. So we're proposing it comes in from something like 2028 when inflation is back to target. It does have an impact on the unhealthy foods that are affected, and that's why that proposal is specifically in order to lift the two-child limit that you mentioned earlier, which would benefit families who particularly struggle with the cost of living.
I mean, as an economist, are you concerned that what we're going to hear in the budget in autumn is going to add to the inflation problem for Britain and the Bank of England?
I think we'll have to see what happens, but I do think not adding to that inflation problem should be a key part of the Chancellor's thinking as she looks at the different tax options on the table.
Would you admit that her tax rises already have added to the inflation problem?
So I think the employer NICs rise will have had some effect on prices. That was expected. I think we've particularly seen effects at the lower end of the labour market. We've seen falls in employee numbers, particularly in those sectors that were heavily affected by those rises.
Just big picture. We're 15 months in to Keir Starmer's premiership. Why hasn't growth been better when it's his top priority?
So look, growth since the Labour Party came in hasn't been bad compared to the sort of averages we've seen since the financial crisis. But obviously those averages have just been really, really low for a long time. And the bind for the Chancellor really comes from the OBR deciding that they've been too optimistic for quite some years. So what we have is a problem of the supply side, of growing the supply side of the economy. And I think that will take time, even with a government that's taking the right measures. But I hope that they do more to address those issues.
So as Britain's most influential think tank, one of, is there not a big idea that you could serve up to the Chancellor, like when you had Blair and Brown making the Bank of England independent, that would grow the economy, that's uncontroversial and free, a silver bullet? In 14 years in opposition, was there not one big idea that they could have come up with that you could offer them?
So I think the thing that comes closest to your question is the idea that we need to have much higher levels of investment in the country. The Chancellor did change the fiscal rules in order to allow her to have higher levels of investment, and that's something we at the Resolution Foundation are very supportive of. I don't think there is an institution like was done with the Bank of England that can create growth just through kind of institutional change, but there is lots she could do. It's good that the government are addressing planning, but she could go further. We do think some of these changes to the tax system that would be controversial could also be good for growth. So there's more that could be done.
OK, well, listen out for those ideas in the speech and at the budget, of course. But just finally, Ruth, before I let you go, does it damage Labour's economic credibility that you've got the Labour Mayor of Manchester, Andy Burnham, saying that the government shouldn't be in hock to the bond market, that there should be another £40 billion of extra borrowing?
Well, look, I think we saw earlier in the year that the Chancellor's fiscal credibility is quite important to this government, and I think sticking to those fiscal rules is important for the bond market. Equally, I hope that the government will take a step back and make the right economic choices and not focus too much on day-to-day swings of the bond market, which seems to have become a kind of more recent feature of UK fiscal policy.
But of course, Andy Burnham is presenting himself as an alternative candidate for Prime Minister. Do the economic policies that you've heard from him sound responsible so far?
I don't think I've heard enough of what Andy Burnham thinks to really comment, I'm afraid.
All right, well, I'm sure we'll be hearing a lot more from him this party conference. I've seen him on that schedule many, many times over the next couple of days. But for now, Ruth, thank you so much for joining me. Ruth Curtis, CEO of the Resolution Foundation. Back to you.
OK, Lizzie, comprehensive. Thank you very much indeed. Bloomberg's UK correspondent and anchor, of course, Lizzie Burden, on the ground for us at the Labour Party conference in Liverpool. We will be heading back to Liverpool later for an interview with the UK Chancellor, Rachel Reeves, 9:15 a.m. UK time. Do not stay away from that conversation. Coming up, Moldova's ruling pro-European party is on track to win re-election. We discuss what it means for relations with Russia and the war in Ukraine. That's coming up. This is Bloomberg.
NATO, Germany, our countries do not have any interest in escalation, but Russia perhaps wants to lead us into a trap, as you mentioned. But Russia has to know we are prepared for each and every situation.
German foreign minister saying that NATO is ready to defend against any Russian incursion, which will continue to remain a focal point when it comes to the Warsaw Security Forum kicking off later today. For now, we're joined for more by Bloomberg's Piotr Skolimowski. Piotr, walk us through what we can expect at the Security Forum that, of course, is attracting some of the defense elites of the world.
Yes, indeed. So it's an annual event that gathers a lot of people from security space and a lot of ministers and foreign ministers and defense ministers. So we're going to have German, French representatives, as well as a lot of officials from Eastern flank, from Baltic states. So obviously for officials meeting here, what's important is basically they're going to first of all compare notes to what they've heard in Anga. Many of them were already there. Many of them actually heard very reassuring tones from President Trump on two things, basically. One is definitely a much more positive tone when it comes to Ukraine. Although U.S. is not willing to pay for military equipment for Ukraine, it's definitely President Trump said that encouraged Ukraine and said that it will be capable of actually gaining more land. We already heard about Ukraine also talking, President Zelensky said that, about obtaining more long-range capabilities from US, which obviously will be paid by Europe. So that's one thing. And another is obviously the fact that President Trump said Europe, if there is need to shoot down Russian drones or Russian objects that are in NATO airspace, should go ahead and do it. That was something that they did want to hear, and it was a very strong statement. And it's something that they're going to continue talking to in on the sidelines and during the forum. One thing that's being discussed, especially among the Eastern Europe flank, is the creation of the so-called drone wall, which will prevent the incursions, but also help NATO states adjust the type of capabilities they're using. So they're not using very expensive missiles to shoot down very basic drones. So a lot to discuss over these 2 days in Warsaw, definitely.
Piotr, we also heard that Moldova's ruling pro-European party is on track to win re-election, keeping the country on path for EU membership. Is this something that the Russians are likely to see as an escalation in any way of their situation on the border?
Well, definitely what we're hearing right now is that, there's like collective sigh of relief from European capitals that this election went through. We've seen enormous amount of Russian interference. We did our own reporting to show documents proving that Russia has been all over it and trying to influence this election in various ways, through cyber threats, through protests, and so on. Russia has been trying to influence Moldova's elections for a very long time. We've seen 2 other contests in the past year. One was presidential election of Maya Sandu, whose party actually won today. So she narrowly won her election last year. The country also passed a referendum to enshrine the goal of EU membership in its constitution. It also passed very narrowly. And among a lot of allegations about Russia's influence and attempts to influence the vote. So we've been there before. Clearly, Russia has denied it's ever been involved in this kind of actions. But for Moldova, what matters is that at this point, what we're going to see today at least, the opposition party led by the former president, a pro-Russian party, led by Igor Dodon, is going to stage protest at noon in Chisinau, basically protesting the outcome of the election. So that's potentially a certain flashpoint we're going to have to watch out for. But down the line, joining the EU is not an easy process. It takes years, and Moldova wants to join by the end of the decade. And to prepare for that, they'll have to make a lot of sacrifices, and they'll have to make a lot of changes still, a lot of reforms. So that's something ahead of them. So once the euphoria subsides, we are going to get down to work, and that's something that's still ahead of this, one of the poorest countries in Europe.
Okay, still a long road to travel then for that nation. Bloomberg's Piotr Skolimowski with the update, of course, on the elections in Moldova. Thank you. Meanwhile, President Donald Trump and top congressional leaders are set to meet to discuss a short-term spending bill to avoid a government shutdown. While Democrats are insisting on healthcare provisions, Republicans want to address those issues later. For now, let's bring in Bloomberg's Balázs Pence. Balázs, where do the two sides then currently stand heading into, I guess, what could be a make-or-break meeting?
Well, Tom, the two sides seem pretty far apart, as is customary, so close, less than 2 days before the deadline to continue funding the U.S. government. As you said, the Democrats want assurances on healthcare spending, and that's not something that the Republicans are willing to give right now. So the two sides are both sounding very determined, as they would before high-stake negotiations like this, and they're both busy trying to frame the debate in a way that would put the blame on the other side should the government end up shutting down. So certainly there's a lot riding on this meeting. Democrat leader Chuck Schumer said that they want to see a meaningful negotiations. They're not interested in the president trying to browbeat them into submission. And with less than 2 days to go, there's a very little time to bring the two sides closer together.
Balázs, what happens if there is a shutdown ultimately when it comes to Tuesday at midnight U.S. time? What happens on Friday when it comes to the jobs report?
Well, we cannot rule out that there will be a shutdown. We have to remember during President Trump's first term, the government shut down twice, and that brings in a host of different implications, from government workers being furloughed to, yes, some of the statistics being halted, some of the government's very important vital work for the economy being halted, not being able to fund. And we have to remember, even if there is a solution now, even if they are able to agree on a resolution for now, that's only for 7 weeks. So we might be back here talking about this again in less than 2 months' time.
All right, Bloomberg's Balaj Pence, thanks for joining us on the latest on the government shutdown with less than 48 hours to go. But let's look at the other catalysts that we have on our mind this week. Today, Trump is busy at the White House. Not only is he hosting the bipartisan leaders to discuss that shutdown, he is also meeting with Netanyahu in the White House later today. On Tuesday, the Trump tariffs come into effect at midnight, those that he announced on Friday, with a keen interest on the pharma tariffs hurting domestic manufacturing here in Europe. We also have the U.S. government shutdown going into force at midnight on Tuesday if the leaders don't come to some sort of agreement. On Wednesday, Euro area CPI and Golden Week begins. We've not really talked about this very much, but it is seen as a good indicator on how consumer sentiment is holding up in China. That lasts for a whole week, and markets are shut out in Asia. And then on Friday, the non-farm payroll report. The big question just remains to be whether we get it or not, whether the shutdown happens and that data is delayed, which essentially would have the Fed going in blind to this October meeting, not having their monthly update on payrolls.
Should we mark gold at this point? Because that has been one of the reaction functions for gold, or at least some of the catalysts. $3,800 above that for the yellow metal, if we can show that pricing, because gold has rallied. One of the aspects, I mean, through the year, of course, it's been on an absolute tear. But another catalyst for gold has been the uncertainty, it seems, out of the US. Fresh record highs for gold.
Yeah, absolutely. It's fascinating that's coming at the same time as Golden Week as well, which there's always that correlation there as well in terms of the physical buying. I think it's fascinating, though, if we just do some scenario analysis, just because I think we have a little bit of time to do this. Can we just game out what happens on Friday if we don't get a jobs report? What does that look like? So on the one hand, you look at ADPs as one potential scenario. Another is the market panics because we don't have a data set. Is there a reaction function from some Fed speak? How do we piece this together?
Well, I think the big question would then be on the timeline of the shutdown, and perhaps would it be done with enough time for the Bureau of Labor Statistics to reinstate the data point before the Fed convenes at the end of the month? There is a lot of time to do that, and as a reporter mentioned before, these shutdowns normally only last for 14 days. I think that's the average over the last decade. So there still maybe would be room to get this data set out. But yeah, would the market just rely on ADP, which doesn't always chime with what we get with NFP on Friday, where they perhaps look at the jobless claims of last week, the fact that they have been declining to a low not seen since July, and say that that's a strong enough labor market for me. Maybe the Fed doesn't need to add an incremental dovish language in October.
So our previous guest, Michael Hunstead, of course, saying that, look, history shows us that markets rebound pretty quickly, equity markets at least, from these events. We've had them in the past where they've shut down, and I think he gave a framework of around 3 months afterwards when equity markets kind of remake gains. So on the equity market front, he was pretty looking at it as a pretty benign scenario, but clearly that uncertainty is there.
It's fascinating because you could at least come at the end of the year looking at a stock market rally and a gold rally that comes kind of at the same time, which is something I don't think we see very much. We should just, as we wrap up the program, give you and leave you a programming note. On Wednesday, we're very excited to say we have live coverage of the Women, Money and Power event right here in London, covering the most influential female voices in finance from around the world. We'll discuss key themes facing the future of business. GSK's Emma Walmsley will be among the panelists, who, of course, is nearing the end of her term. And, of course, Chancellor Rachel Reeves in about 15 minutes' time. Stick with us. This is Bloomberg.